Hi, this is Marie Conser. I'm a real estate broker in Oregon, and my guest today is Tim McBratney. Hi, Tim.
Hey, Marie, how are you? Tim McBratney here with PacRes Mortgage.
Yes, and I am well. Thank you so much. I wanted to have a quick chat because 2023 is looming and some news are coming out for 2023, and I wanted to jump in on that with you.
Indeed.
Putting on the screen first, the loan limits. So loan limits in 2022, and yes, can you speak of that?
I
This
sure
year,
can.
next year,
Yes,
what is a loan limit, et cetera, et cetera?
yes, indeed. Happy to. So, like many lenders in the United States, we sell our loans to Fannie Mae or Freddie Mac, and they will buy what are called conforming loans. And by conforming, they must be within a certain loan amount. And Fannie Mae and Freddie Mac set that loan amount. Actually, it's their overseer, which is the FHFA, and they base it on kind of the median sales price in America. And last year we were up at 647,200, and going into 2023, that's going to increase all the way up to 726,200, and it is now official. We've been speculating about it for a couple of months now, but it is now official and in the books, and we can close transactions clear up to that amount right now.
So we can go under contract today for a loan at 726,200.
That is correct.
Okay. Does it have to close in 2023? Can it close in 2022?
It can close this year.
Wow, wonderful. Okay,
Yeah,
well, that
2022.
is so. From a real estate standpoint, those loan limits are helpful because as the appreciation of home prices have gone up,
Indeed.
this helps staying within what you mentioned, conventional guidelines. So what
Indeed.
does that entail, conventional guidelines? Is it like a different set of credit scores, better rates? What does that look like? Down payments?
Yeah,
What does
great
it mean?
question. I think probably the immediate and essential benefit of a conforming loan amount below 726.2 is that you take the benefit of the very low down payment options. So remember, if you're a first-time home buyer, you could put 3% down, and that probably equates to a sales price of about 750,000 or so, and borrow 726,200. If you were to get up into the jumbo range, say you had a loan amount of 750, most jumbo products require 20% down. So it's really beneficial to stay at that conforming limit. Probably a little bit easier underwriting guidelines, a little bit simpler to get into a home than jumbo, and probably quicker turn times and turnaround times.
Good. So we are obviously not advocating that you borrow $726,200, but it does express that we are able to stretch that dollar amount in the conforming loan within
That's
the
correct.
conforming loan limits in order to leverage everything you just said, lower down payments.
You bet. And let me reiterate, if you're a second or move up buyer, you can put 5% down or 10% down. So many people still believe it requires 20% down, but just know that Fannie Mae and Freddie Mac do allow a very low down payment on a home purchase.
Good. So now, of course, the other side of a loan is the interest rate, right? And 2022 has been a surprising year because even though everybody was expecting the rates to go up, nobody projected that they would go up that high that quickly.
Indeed.
So what are we seeing now as we are about to start December here?
Yeah, indeed. So the good news is, first of all, let me explain that interest rates are really a function of inflation. And as we've heard every day in the news, that inflation has reared its ugly head this year, and I think we're up near 8% as an inflation rate. And if you are on a fixed income and inflation is eating away at your buying power, then boy, you sure want you sure want rates to go higher so that they can increase your yield on your fixed rate investments. So hence rates do increase with the rise in inflation. So the very good news is, of course, the Feds have been raising short-term rates to stem or cool down inflation. And I think they've done a good job because we're starting to see the results of that. In fact, today, Jerome Powell spoke and he said that they think they're seeing enough signs of a cooling that they're going to ease back on their rate increases. And the mortgage-backed security market, which is sort of our raw material, has already reacted and responded very positively to that. So we've gone from probably 7 1/8 down to, I think the mid to high 6s. And tomorrow is also going to be a very important day. So we may see some further reductions in rates. So we're being cautiously optimistic that tomorrow will bring even more good news.
Good. And we are seeing that we broke back down below 7%, which is nice.
You got it. That's beautiful.
One of the questions I continue to get is, will there be a wave of foreclosures? I don't know. I mean, of course, nobody has a crystal ball. Nobody can predict the future. The fundamentals, though, are very different from 2008. And the numbers right now look like this. I want to point out that the very, very low rates of foreclosures, those are nationwide numbers, by the way, but the very low rates of foreclosures during the pandemic years was partly due to foreclosure moratoriums that were in place. It is inching back up. Some of the big the states that have been hit the most recently in Q3, at least, it's Illinois, Michigan, New York, Pennsylvania, and Ohio. But what's the biggest difference is at this point is the amount of equity, the average amount of equity that people have in their houses. So Tim, can you speak to that?
Yeah. Imagine, if you will, if you had a home that was, that you might have $100 or $200 or $300,000 worth of equity in it. Boy, you're really going to do a whole lot more to maintain that home as your own home than, say, if you were upside down. So back in the meltdown era, 2008, 2009, a lot of homeowners owed more on their home than it was worth, and so they weren't as motivated to keep the home. So that built-in equity that we've enjoyed over the past couple of years is really helping people to do whatever, maybe take a second job or wherever it may be, right, to not go into foreclosure.
And Rick Sharga, who is the executive vice president of market intelligence for Atom, which is the source of that previous graph here, was noting that there are few properties that are reverted to the lender. There were actually 3 times more homes back in the second quarter of 2019 than in the second quarter of 2022. And the belief there is that the borrowers are leveraging their equity indeed, and or selling their homes to rather than risk the loss of their equity in their homes.
Indeed.
So yes, it ties into this. So not foreseeing a wave of foreclosure, at least not in a near future here, and encouraging news for both buyers and sellers, because the real estate market is very tight to the interest rates. So with interest rates stabilizing and inching downward, or at least heading into that direction, hopefully, might still be up and down between now and there. But this is encouraging for everybody. So thank you so much for your time, Tim.
My pleasure. Always nice to talk.
Yes.
Thanks so much.
Thanks. Bye-bye.